You guys been hearing the term missing middle and wondering what it is and how does it get financed? Well, stay tuned in today's video as Josh and I break it down.
Hey guys, Josh and Ehren back for another Finance Friday, and today's video we're going to be discussing financing the missing middle. So kind of a buzzword, you've been hearing it a lot lately. What is the missing middle and how do we go about financing it? So, the missing middle essentially is the middle of the economy. So we're going to take a look at the mid-sized multifamily real estate. We're going to take a look at the small multifamily real estate and just essentially where is it lacking in regards to financing? How do you go about financing it? What are some of the constraints around financing it, and how are we navigating the debt markets to be able to help grow this missing middle?
Yeah, in terms of construction financing, specifically, we're taking a look at CMHC on the purpose-built, so not building condos for sale. The majority of the lenders aren't looking at construction financing unless it's under $10 million. Prior to the CMHC updates that came out on June 4th, a broker could submit into CMHC, get a COI, and we go take it to construction lenders that were looking at stuff under 10 million, that 5 to 6 million, maybe 3 to 4 million if it's a strong on a project. But these lenders, they aren't doing the due diligence and CMHC submission themselves as of right now. Does that change with some of the policies that have come into effect? And are these lenders going to bring on a diligence team that's going to have a support staff for submitting to CMHC? That's kind of yet to be seen. So it's a little bit of a kick, to a level of financing that was already pretty tough to get.
Yeah, it's kind of a tough conversation to have with clients who, are moving out of that small residential space, looking to get into this mid-sized, smaller development space. And when they say, my cost to construct is $3 or $4 million, in most of their eyes, that's a lot of money. And, to tell them, listen, there isn't really an appetite for something like that for the top tier debt of financing, it's kind of a hard pill to swallow. So understanding the options that are out there, these options are less advantageous when it comes to loan to cost, so getting all your capital back or being able to get as much capital on the onset of your construction financing. But I think a lot of mortgage investment corporations are starting to see this as an opportunity. More advantageous financing options for good areas are popping up along the 401 corridor, Kitchener, Waterloo, Hamilton, Cambridge, Guelph, London. Those corridors, there's a lot of investment going that way. So giving the opportunity for these smaller mid-sized developments to continue to grow. And you might ask yourself, well, why do people take mortgage investment corporation money over conventional capital? And this is kind of where the missing middle kind of gets, or developing the missing middle kind of gets lost in translation. So when you're getting construction financing, your construction financing is really based off of the total amount of debt your project is going to qualify for at the back end of the project. Now, it's great that you underwrite your brand new 20-unit building with CMHC financing on a takeout. Yes, it's going to work. Yep, we can take you there, no problem, after the project is complete. But your construction lender, they're not going to see it that way if you're going to a regular credit union or a bank. They're going to see it as the only way in which they can pay out your financing at the end of the project. So you're not getting, a 50-year amortization. You're not getting ridiculously high loan to cost valuations. So what they're doing is they're choking down the amount of capital you can have. And a lot of the people who are getting into this space are having problems with getting the large amount of financing that they need, or they're getting liquidity constraints because these are some bigger projects they're getting into. So we're seeing a lot of clients move towards a mortgage investment corporation that can still incorporate using the MLI or the CMHC equity takeout products at the back end of the projects, but still allowing them a little bit more leverage than you would normally have with conventional financing options.
Yeah, and taking a look at CMHC specifically, and why aren't lenders funding these smaller projects, or why aren't the majority of them funding? There's a few different things. Obviously, one, when you're a larger lender that's dealing with larger developers and larger loan sizes, you got to understand that CMHC capital is restricted. There's only so much that we can allocate from the bonds to be able to put out into developers, right? It is a buyback type program. So, these larger lenders would rather hold on to that capital and be able to put it out onto the $10+ million projects, where from their perspective, The guys doing the larger projects, tend to have better guarantee, safer, more experience. It's a less risky investment for them, giving it to someone who's getting into their first infill development, looking to do $2 to $3 million projects. Even though the smaller projects, tend to be a little bit safer than the larger ones given these days. But again, it all comes down to the amount of capital that's available in the CMHC programs and the amount of time that it takes to underwrite these loans. It still takes the same amount of time to underwrite a 2 to 4 million as it does a 10 to 20 million, and you still have to allocate resources, site inspections, QS, stuff like that. So again, from a lender's perspective, they'd rather just save the time and effort and allocation and save it for the larger files than putting it out on some of these smaller ones. But there's lots of other reasons to take some of these alternative non-CMHC, non-insured mortgages as well too. Josh mentioned a couple in terms of structuring, but also taking a look at like some of the other options. Like a lot of these MICs have their own in-house cost consultant, so you don't have to go get a third-party cost consultancy report done. It's done in-house. It's quicker. It's cheaper. It's done in the lender, so the lender has hands-on insight into what that looks like, so you can work with the budget a little bit. But also there are tranche times in terms of how long does it take from submitting in receipts to be able to getting funding. Insured, conventional type debt, you could be 2, 3, 4 weeks sometimes, depending on how busy is the lender, the lawyers trying to get an appraiser out there, trying to do some sort of like quantitative survey. Like it all depends on, the timelines of everybody. Whereas these smaller MICs, because they advance everything to the lender or to the lawyer already, you can get funds turned around in, 3, 4 days sometimes, as long as it's pretty simple, right? So in today's market where there's not a huge influx in great contractors and the great contractors are picked up pretty quickly, you want to be able to keep good contractors on your site. If you have to wait 4 weeks, 3 weeks, that contractor wants to make money. He might be off doing another project. Now you got to wait another 2 weeks, 3 weeks to get him back onto your project. Whereas if you can pay him in the same week, he's not going anywhere. So it's going to help keep you moving forward. It's going to be helping to expedite the project. The structuring and the servicing of these alternate lenders more than make up for some of the loss that you get with CMHC. You don't have to worry about price bonding. Like there's just so many additional benefits.
I couldn't agree more, and I think that it's really important to understand that if you're going to get into this mid-sized development stuff, the actual service cost is the same whether you have a big project or a small project. Like for example, the QS, like tens of thousands of dollars in your project to be able to move this along, and a lot of the larger development lenders require a cost consultant to be able to get this done, or a quantitative surveyor to be able to confirm the cost in your project. This could widely throw off your overall profit on the project. Your total capital costs. These lenders are going to price you in at a higher spread than what you're going to have on much larger deals as well. Its cost is going to be much more. Unfortunately, the way it's going to work is these smaller projects are going to get priced out on the profit that you're going to be able to make, and you almost have to go. They're pushing people to go much larger to be able to get these projects done, but that missing middle isn't just a metaphor. It's quite a significant issue because the profitability on these projects just isn't there when the cost to get the phase 1 environmental, the phase 2, the cost consultant, the geotechnical report, all these reports cost the same amount of money, so your profit is just getting squeezed. So what is that going to look like in regards to helping developers get into moving these projects forward? Well, the government's doing it right now. They're increasing density. They're not requiring site plan approval on anything under 10 units. And we're starting to see more products for the take-up financing, allowing at least for the equity that's injected in these projects to come back to them after the project is completed.
Yeah, I mean, like a ton of great points. Looking at obviously the big thing of comparing a CMHC loan to a non-insured type loan is, CMHC offers 95 to 100% loan to cost. Like, why am I going to want to go take something less? Well, some of these alternative type lenders will actually run your construction loan based off of your as complete value, 70 to 75% of your as complete value. When we take a look at that and compare that loan size to the cost of your budget, you can get pretty close to, depending on the strength of the project, up to 90, 95. I mean, like it's not out of the question to potentially be able to get 90, 95% loan to cost. Some of these alternate lenders will even do up to 100% of your hard costs anyways. Again, so, they offer a lot of benefits. When you really just kind of stop and take a look at everything and how it stacks up, you can get a pretty competitive offer from these alternative guys. Yes, your rate is a little bit higher, but again, you're not paying that interest from day one, right? You're paying it as the tranches are advanced. It's usually just deducted from your advance anyways. So it's out of pocket, but you're not kind of feeling that pain of paying, 9.5%, 10% on your interest every single month. It kind of gets hidden in the way the fees are advanced or the loans are advanced. So, there's a ton of benefits.
Yeah, and I think that's where a lot of these mid-size infill development is going to be moving forward. That small construction, they don't require the same experience from these people who are looking to move into it. And remember, guys, you can't just get into massive development. It doesn't work like that. Like, the lenders won't just allow you to be able to get into a 40-unit construction or a massive 100-unit townhouse development. You can't just show up and say, well, I have no experience, but I have some capital. Maybe I can do this. A lot of it is going to be leaned on your previous experience. What projects have you finished? Your team that you have around you, what projects have they finished? What does your development experience look like? And can you manage a project of this size? So I think what we're seeing is handfuls of guys who purchased small multifamily real estate who are pushing up into this mid-sized development because of maybe landlord-tenant challenges with Ontario. We don't foresee that being fixed anytime soon, at least in Ontario. And the profitability of being able to deal with the new increased densification and opening up of permittability, I think this is a perfect storm for people who have a little bit of capital, who have a little bit of experience to get their feet wet and start to develop some mid-sized projects.
Obviously, another hot topic is the addition of ADUs. Unfortunately, right now, there isn't a specific construction program available for just the addition of a single ADU. And typically, when you take a look at the cost to build these, it's not enough for a construction lender to want to put together a tranche type product anyways. The easiest and best option is utilizing secondary equity type products. So home equity line of credits or, second mortgages blanketed on, one or two different properties, pull up the funds, build the ADU, take that into your refinance. You're taking a look at some of the new zoning allowances like in Toronto where you can have a fourplex plus the ADU. That 5-unit complex is able to go into CMHC. You can still refinance into CMHC on the back end. Take those funds out, pay out that loan and take that equity back into your pocket. If you're building, with these new zoning changes, 4x4 type project, buying land, severing it, building 4x4s, you can take that whole Aplex into CMHC on the back end as well too. So there are a lot of creative options on the financing side. The smaller stuff like ADUs on the construction financing, it's a little bit more difficult. We have to tend to use more, like I said, private debt, like hard money type debt or existing home equity line of credits. You can get home equity line of credits on the A side. B lenders offer HELOC products. Private lenders offer HELOC products. So there's tons of different products out there depending on your affordability and what you can qualify for. And again, secondary private debt. So lots of options there, and then lots of creative options on the back end to be able to take that debt out and pay it out.
Unfortunately, the big five banks really haven't figured out a way to be able to restructure this debt from a value perspective still. We're still having problems with outbuildings and determining additional value with having this ADU in the back. Historically, what we've done is we've used commercial financing options with small commercial debt to be able to take on a DSR ratio analysis to refinance these properties. So if you are looking to refinance, let's say with a big five bank, just understand there are sometimes challenges with being able to add that additional value with the ADU that you just put in. So there might be some challenges in the back end of refinancing that and wrapping that loan into a new mortgage.
Yeah, and these smaller ones are probably going to be, like in terms of taking a look at some of the changes that have come with energy efficiency, enforcing affordability. Building an 8-unit building and having to have 10% of your units affordable, that's 1 out of the 8 units. If you taking a look at it from like a cost perspective, expenses, these residential properties, you can basically pass all of your expenses on to your tenants. So, when you take a look at essentially eliminating all of your utility expenses, that kind of makes up for the loss of income that you would get for a single affordable unit. So you can kind of stretch your qualifying this way in conjunction with the energy efficiency now that you can't get all 100 points. So I think this is why it is a really popular product right now, and it's only going to become more popular moving forwards.
Yeah, I think that the opportunity right now with all the policy coming into effect has never been more great. I think that developers have been wishing for this day for the last 20 years in Ontario, and with red tape being cut and upzoning automatically happening to residential units, there's a lot of opportunity in the market right now for developers and investors to be able to find unique opportunities, side-by-side triplexes, side-by-side fourplexes, adding additional units. Understanding the intricacies of how to add those units and doing it in a way in which the units are legal and your exit strategy is defined in the back end is probably the name of the game here. If you guys did like this content today, we really appreciate you watching it. If you could hit the subscribe button, hit the like button, it allows us to make more content like this for you. I really appreciate it.